Hey, Jason here. Getting back to the investment analysis after a week-ish break. Today, we're going to cover Airbnb for Neil F., who requested this on YouTube. Before I get to that, though, I'm going to tell you all you need to know to figure out if you should invest in Airbnb or not. Before I get to that, though, I need to let you know you can get this series as a podcast anywhere in the world for free on all major podcasting platforms, Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You get this as part of the I Love Value Investing podcast anywhere in the world for free. Also, if you like this video and other videos, make sure to subscribe and hit the notification bell so you're notified every time we release a new video, and release new videos all the time. Okay. Today, I'm going to answer the question, should you invest in Airbnb? Again, this is a stock analysis for Neil F., who requested this on YouTube. Before I get to that, got to do my disclaimer that every time I forget, somebody leaves really nasty comments. So this is for informational purposes only. We're going to go through what I call my preliminary analysis template. We're going to go through the visual part of it here. This is based on my years of experience. This is the exact process I go through anytime I evaluate a stock. The reason I do this, or the reason I'm sharing this with you, is to help you learn how to evaluate and find great stocks to potentially invest in faster. I do not own any stock in any company I talk about, and I do not short stocks ever, which means I don't short any stock that I talk negatively about. I have no personal gain from this monetarily when it comes to buying or selling a stock. I'm doing this to help you figure out and learn how to evaluate stocks faster. Why should you listen to anything I have to say? In the first 9 years of my career, I have posted 23.5% average annual returns in the portfolios I manage. This is just behind I think it's 24.2% Warren Buffett produced in the first 9 years of his career, and what I've done legitimately making me one of the best stock pickers in the world over the last 9 years. I'm not saying that to brag. I'm just saying that I actually know what I'm talking about a little bit, and I would love to help you in any way I can. Okay, that out of the way. Again, today we're going to go over Airbnb, so let me get the video up. Okay, get this out of the way. Okay, Airbnb is the worldwide, not home swapping, what is the term I'm looking for? Accommodation agency. It's like a giant hotel from people's homes and properties they own, stuff like that. First thing is their gigantic market cap. Second thing is their unprofitability. These are the first two things I notice. Here, price to sales. This is one sign. The forward PE being not showing up likely means it's negative, which means they're unprofitable. Price to sales being at 15.5 rounded up is really high. I don't use price to sales ever, but I do know what a kind of quote-unquote typical price to sales is for an undervalued company or allegedly undervalued company, and it is not 15.5. That is real high. Okay. So revenue going up pretty fast from 2.6 billion in 2017 to 4.8 billion in 2019, and then a huge drop in 2020 due to COVID, which makes perfect sense since most of these Airbnbs worldwide rely on travel and people traveling, and travel was for the most part either locked down completely or severely limited due to the COVID pandemic. That makes sense that revenue fell. I'm actually frankly surprised it didn't fall more than that. It fell from 4.81 billion rounded up to 3.4 billion rounded up in 2020. I'm actually surprised it didn't fall more than that, to be honest. Operating profit. Unprofitable. Ooh. Massively unprofitable in 2020. They generated about $3.38 billion in revenue in 2020, and they lost on an operating income basis $3.44 billion. That is gigantic. Another way of putting that is for every $1 in revenue Airbnb generated in 2020, it lost more than $1 in operating income. I would want to know what happened here. That doesn't make sense combined with the COVID stuff, that they would lose that much money unless they majorly upgraded their marketing or something. I'm not frankly sure what happened there. I'd have to figure out. Actually, let's do it now. Airbnb. Oops. Airbnb. So they recently released their, and I'm a little bit familiar with this company. This is from an old article I was looking at, but I haven't. So I know to a degree, but again, this was 2 weeks ago, so I don't remember exactly what happened and why that huge loss was. And again, this exact process I would go through every time I look at a stock. If I come up with a question, I will go to figure out what it is. That's not useful. Airbnb fourth quarter loss. Oops. Let's go to this one. Okay. Resilient and adaptable. Get out of here. Haha. Okay. This reminded me what it was. Okay, so they IPO'd on December 10th, 2020. So as of this recording, about 4 months ago. And because their stock went up so much, they had a huge expense related to IPO related compensation to insiders, executives, stuff like that. So that's what the huge expense was. And I forgot about that. Because of that $2.8 billion expense, again, related to the IPO and IPO compensation, that is why their loss was so gigantic. Okay, that looks like what it is mostly related to is that. So what does that mean come in a real world sense for the evaluation? Not a huge deal. I mean, yeah, it sucks. You lost a lot of money. But this is essentially a one-time cost that the company shouldn't have to pay going forward unless, again, in their S1 before they went public, which I have not read, they have a lot more IPO related expenses. For example, what's their share price? An example might be if their stock goes over $150 per share, they have to pay out XYZ amount of compensation to insiders, executives, stuff like that. If it goes over 200, again, same thing. I don't know what's in their S1. I haven't read it. And frankly, that would take too much time to go over right now. But this is generally, the way to look at this is should be a one-time expense, again, depending on what's in the S1. So it's not a huge red flag here. Same thing with the net income. This affects both operating income and net income. So not a huge deal. Going forward, again, sucks to lose a lot of money, but their stock is skyrocketing. So not necessarily a gigantic deal. Book value per share, can't really tell. Not really important for this kind of company anyways. Free cash flow. Positive every year, surprisingly, except for last year, which again, this is partially related to the expenses related to the IPO. ROIC, again, because of the these are all going to be jacked up. All these metrics we're going to look at, not only because they recently IPO'd in December 2020, so they don't have data going back most of the decade like I usually like, but also because of that huge expense at the end of 2020 related to IPO. So all of their metrics are going to be massively negative. Yeah, free cash flow, massively negative as well. Okay, so none of that, honestly, is the profitability and cash flow metrics. are useful in this case. Again, most of the time that's where I spend most of my, or put most of my faith in, is the metrics over a long-term period of time. Because they recently IPO'd, we can't do that, and also because that expense is messing with the 20-year data. It's also not necessarily a true indicator as well. 60% of the balance sheet is in cash and short-term investments. Love that. That gives it a huge margin of safety when issues come up, which is frankly still what we're dealing with today with the COVID stuff. Interest coverage ratio, I've covered this in a lot of videos. When it's negative like this, it means the company cannot cover their interest on their current debt payments with earnings, which of course makes sense in this case because they're unprofitable, again, largely due to that huge expense. Again, not necessarily a true indicator of its financial worth here. Normally that's a gigantic red flag, but again, because of those one-time costs, you got to be careful with that. $2.3 billion, or $6.4 billion in cash versus $2.3 billion in debt. So they're in a net cash position on the balance sheet, which is great. Gives them more margin of safety. Equity doesn't really matter, frankly, for Airbnb much. But it's good that it's still positive. It adds more margin of safety. And again, normally here I talk about valuations. I cannot, because they're negatively profitable on an earnings basis, on a cash flow basis, and an operating income basis, which you don't even see the EV to EBIT here. Okay, so this has frankly been probably quite a boring analysis so far, but I'm going to do something a little bit different here because there's not much information here, and because it's all jacked up due to that one-time huge expense. Let's look at their chart. This is what I'm talking about when it comes to their, oops, that's not exactly a great look. There we go, that's better. From their IPO. They IPO'd, I don't remember what the IPO price was, but they opened trading at $146.86. In that time, they're up, and that's not right. That's not updated, because they're up to almost $200 a share, or they're up almost 10% today. Why? They just released earnings in February, so they shouldn't be doing that. So what is the overall market going nuts? It's up 300 points. I don't know. I don't have an answer for that. Why its stock is going up today so much. Stimulus passing. Again, I'm not really sure. Okay, so that was, again, not very useful. One thing I will note here is because of its huge market cap and its unprofitability, I want to show you how to value and stock that is unprofitable, or at least one of the ways I do it. So when a stock is unprofitable, you can't look at the metrics here. You can't look at the other metrics on the valuation tab. Their balance sheet, frankly, doesn't matter that much, because they aren't a hard asset like company, like a manufacturer or something like that. So their balance sheet and their book value don't really matter that much either. So how do you value an unprofitable company? The way I do it is by comparing it to another company of a similar size. So to find that, we're going to go over here. And we're going to find a company that has around 100. Oops, where did I select here? Oh, okay. Or right around $120 billion market cap. And that would be Lowe's. Let's go with Lowe's, because they are a hard asset company. So let's go with them. Lowe's. So LOW. Okay. So, Lowe's, $126 billion market cap. Airbnb, $121 billion market cap. So similarly sized, which means they should be, or which means they have the similar price. And I have this conversation with students all the time, that there's a difference between price and value when it comes to stocks. The price is the market cap. This is what essentially the stock is selling for today on the market as an entire company, which in this case, 121 billion for Airbnb, 126 billion for market cap for Lowe's. What I want to try to find is the value. You can't do that with Airbnb just by itself, in my opinion. Again, I never use price to sales. Frankly, I think it's essentially a useless metric for the most part. Its price to book doesn't matter much because of its operations, and it's unprofitable on an earnings or a net income, operating profit, and free cash flow basis, which is, I usually use operating income and free cash flow to value business. Can't do that with any of those metrics because it's unprofitable. So here's how I find the value of a stock. Or again, not the intrinsic value, the relative value, because you're comparing companies to each other here, so it's not an intrinsic valuation, it's a relative valuation. Okay, I hope that makes sense. Where are we at here? Okay, so, oops, Lowe's already had open, Airbnb do not. Okay, so they have similar market caps. Airbnb in the last year produced $3.4 billion in revenue. Rounded up, Lowe's generated $85.3 billion in revenue. Lowe's in the last year produced $9.1 billion in operating income, while Airbnb lost $3.4 billion in in operating income. Lowe's produced $5.4 billion in net income. Airbnb lost $4.6 billion in net income. Airbnb had lost $667 million in free cash flow. Lowe's made $9.9 billion in free cash flow in the last year. These are all important because over the long term, I'm going to bring you back here to my face, so I'm not talking to a blank screen. Okay, over the long term, companies are valued based on the profits and cash flows they produce. If a company is unprofitable, in the short term, it can still have a huge valuation because of things like growth, expectations, momentum, euphoria, whatever you want to call it. But over the long term, stocks are valued on their profits and the cash flows they produce. Because they have a similar price on the market, that means their underlying values of both of these companies should be relatively the same. They're not. Again, when you focus on the long term, which is what I do. According to this, and I'm looking at my screen here, Lowe's is about 10x more profitable on an operating income basis, about 10x more profitable just in general on an operating income, net income, and free cash flow basis. And it generates 85, what is that? 85 divided by 3. Do that real quick. So I don't feel like doing it in my head. And about 28 times more valuable if you just look at the revenue. So what this means is that Lowe's should be valued at a far higher rate than Airbnb. Should be. That's key word, or key two words. Because again, in the short term, things are valued on people's feelings, emotions, euphoria, craziness, growth, whatever you want, again, whatever you want to call it. But over the long term, which is what I focus on, companies are always valued on the profits they produce and the cash flows they produce. Always. Now, the big difference here is that everyone's definition of long-term is different. This is how Uber stayed around and stayed relevant because it issues shares, even though I think it's still unprofitable. Last time I looked, it was unprofitable. This is how Tesla stayed around for years until it gained profitability. This is how Airbnb will stay around for years until it gains profitability by issuing more shares, issuing more debt, selling more stock on the market. Growth stocks you can make a lot of money with. But at some point they have to turn profitability. At some point they do. Because if they don't, this is what will happen. Elon Musk, an internal memo he released to his team, it might have been a speech, might have been a memo, said we need to figure out how to generate higher profits and cash flows, or our stock, Tesla stock, will be crushed like a souffle under a sledgehammer. Why? Because again, he knows over the long term, companies divide on the profits and the cash flows they produce. Now, getting this back to Lowe's and Airbnb. What this means is that they have a similar price on the market. And here, I'll take this further. Let's go back. Illustrate this further. Okay. And I forgot to do this. Okay. So, to further illustrate that Airbnb is enormously overvalued, we're going to take a look at Lowe's valuation metrics. Again, if you see my past videos, I don't care much about PE or price cash flow at all. But I generally look for valuation metrics below 20 on these metrics. Same thing for forward PE. Don't really care about it, but generally under 20. So this puts Lowe's at slightly undervalued right now. The most important metric on here, though, is EV to EBIT, enterprise value to EBIT, at 16.8 for Lowe's. I look for anything below 8 on this metric to consider the company undervalued. So this means that Lowe's is about 2 times higher valued than I would consider something to be undervalued, which means it's overvalued, which makes investing in its stock right now riskier, which means you should expect to earn lower returns on it going forward. Having said all this, Lowe's is generating 28 times higher revenue and about 10 times higher net profits, operating profits, and free cash flow than Airbnb. And they have the same or a very similar price on the stock market. That means the values are way off. Airbnb is insanely overvalued right now because of those things. And I'd put Lowe's at slightly overvalued right now to a little bit more overvalued. And it's 10x more profitable and 28x has higher revenue. And it's overvalued, which means Airbnb is insanely overvalued. Again, I hope this makes sense. This is a kind of a foreign concept to most people. Most people either, if they are into growth stocks, they don't take this extra time and they just kind of look at the future and the price of sales and other metrics and stuff. As a long-term value investor, I look at the numbers now and in the past, and yes, that biases me against it, but this is the way you can compare companies to another to see the valuations. Because unless you can buy something that's undervalued, in my opinion, or at least fairly valued, you bring on more risk, and you should expect, because of that, you should expect lower investment returns going forward. Yes, I know you can make a lot of money in growth stocks. Yes, this means I perpetually find companies like Airbnb, Uber, Facebook after it IPO'd, Amazon, always. These kind of growth stocks, I find them perpetually overvalued, and I miss out on them, even when I see them coming. Because I personally love Uber and Airbnb and Amazon, not so much Facebook. But those three, I love growth stocks. On a personal level, I love technology. I love progress. I love like the space stuff and Tesla, solar panels. I just love technology and innovation. But I pretty much never invest in these kind of companies because I require the investments to have profits now. Unless it's an NCAV, Benjamin Graham, NCAVs type situation where it's just generally a terrible stock and it's massively undervalued. That's pretty much the only time I invest in stocks that don't have profits. Now, yes, again, getting back to my original point, I know this means I miss out on these stocks, but it also means I miss out on the potholes and things that blow up, because not every company turns into a Tesla or an Airbnb or an Uber or an Amazon. For every one of these companies, there are 10 or maybe 50 or even 100 companies that blow up along the way. And yes, while I miss out on the ones that end up going huge and growing straight up like that, I also miss out on the ones that go bankrupt as well. And I'm fine with that. Yes, I know it lowers my returns to a degree, but it also means I lose less money over time, which again kind of levels out and means I earn higher returns. So it's just how I'm built in terms of my mindset. I'm not a growth stock guy, even though personally, again, I love this stuff. From an investment perspective, I separate that out and focus on the numbers now, into the future a little bit, into the past, and all that. So, sorry about that. I got a call. Again, yes, I know I miss out on this stuff, even though I personally love it and personally see a lot of it coming and personally use. I've used Uber, Airbnb quite a lot, and my wife uses Amazon on a daily basis. But again, as a deep value investor, I just can't let myself to do that because I'm not very good at projecting stuff out. I'm very terrible at projecting stuff out into the future. Very bad at estimating stuff going on in the future, which is why I need the numbers now. So I hope that helps. Hope this was interesting. Hope you like this, Neil F. If I missed something, let me know in the comments below. If I didn't explain something well enough, if I should explain something better, let me know in the comments below. If you're listening on the podcast, make sure to, or if you're listening on YouTube, make sure to like, love, share, subscribe, comment, hit the notification bell so you're notified every time we release a new video, and release new videos all the time. Same stuff on the podcast, although on the podcast we would really appreciate your review, because of the more reviews, views, and listens we get on our content, the more people we can help. If you're looking for information on how to become a better investor faster, check out our information below. We have 5 free gifts, which includes the full template, full written template of what we just went through, so you can do it yourself. You can also get my book, a PDF copy of my book, How to Value Invest, and a free copy of our guide, 7 Tips to Picking Great Stocks and 3 Times You Must Sell. You can get all 3 of those for free at the links below in the description. If you want more specific help from me on how to become a better investor faster, also check out below the links to our masterclass, or to my masterclass, and I would love to help you become a great investor faster. Sorry, that phone call frazzled me a little bit, got me off track, but that's all right. So to wrap up, hope you enjoyed this. Have a great day. Talk soon. Bye.